Hello and welcome to the session. Finance and Accounting LO3 be able to interpret financial statements. How can you gauge a company's financial health? By interpreting financial statements, you can analyze and evaluate an entity's performance and position. This video will guide you through the essential components and ratios that reveal a company's financial story. Financial statements are key documents that summarize a company's financial performance. They include the income statement, balance sheet, and cash flow statement. The income statement shows revenues, expenses, and net income. The balance sheet presents assets, liabilities, and shareholders' equity. The cash flow statement details cash inflows and outflows. Analyzing financial statements over time helps identify trends. This involves comparing multiple periods to assess growth, profitability, and stability. Recognizing patterns aids in understanding a company's financial trajectory. It's crucial for evaluating long-term performance. Such analysis can highlight areas of improvement or concern. Profitability ratios measure a company's ability to generate income. Gross profit margin, net profit margin, and return on equity are key examples. These ratios reveal how effectively resources are used for profit. They are essential for evaluating operational efficiency. Comparing these ratios across periods provides deeper insights. Liquidity ratios assess a company's ability to meet short-term obligations. Common ratios include the current ratio and quick ratio. High liquidity indicates a well-run company. These ratios reflect the company's short-term financial health. They are crucial for understanding immediate financial stability. Solvency ratios evaluate a company's long-term debt obligations. They show the proportion of financing from debt versus equity. Common ratios include the debt ratio and equity ratio. High solvency ratios suggest better long-term financial health. These ratios help assess financial structure and risk. Valuation ratios assess a company's stock value. They help determine if shares are overvalued or undervalued. Examples include the price-earnings ratio and dividend yield. These ratios guide investment decisions. Comparing them with industry peers offers valuable insights. Financial ratios are calculated using financial statement data. For instance, the current ratio is current assets divided by current liabilities. Gross profit margin is gross profit divided by revenue. These calculations provide insights into financial health. Understanding these formulas is crucial for accurate analysis. Interpreting ratios involves understanding their implications. Profitability ratios indicate efficiency in resource use. Liquidity ratios reveal short-term financial health. Solvency ratios assess long-term obligations. Valuation ratios guide investment decisions. Together, they offer a comprehensive financial overview. Comparing financial ratios to industry benchmarks is crucial. It highlights strengths and weaknesses relative to peers. This comparison provides context for performance evaluation. It aids in identifying competitive advantages. Benchmarks offer a standard for measuring success. Financial statement analysis uncovers risks and opportunities. It highlights areas of inefficiency or excessive debt. Positive trends like increasing sales can be identified. This analysis informs strategic planning. It is crucial for making informed business decisions. Analyzing ABC Company's financial data reveals trends. Net profit margin increased from 10% to 13%. Return on equity rose from 12% to 16%. These improvements indicate growing profitability. However, a temporary dip in 2022 requires further investigation. Profitability ratios evaluate income generation relative to costs. Gross profit margin shows profit before operating expenses. Operating profit margin measures profitability from operations. Net profit margin reflects profit after all expenses. These ratios provide insights into resource efficiency. Liquidity ratios measure a company's ability to pay short-term debts. The current ratio includes all current assets. The quick ratio excludes inventory from assets. Cash ratio focuses on cash and equivalents. These ratios indicate financial health and obligation fulfillment. Solvency ratios assess long-term debt obligations. The debt ratio measures assets financed by debt. The debt-to-equity ratio compares debt to equity. The equity ratio evaluates financial leverage. These ratios provide insight into financial risk and structure. Valuation ratios help assess a company's stock value. The price-earnings ratio compares stock price to earnings. The price-sales ratio evaluates market capitalization to sales. The price-book ratio compares market price to book value. These ratios guide investment decisions and stock evaluation. Financial audits review and evaluate financial statements. Conducted by independent firms, they enhance credibility. Audits ensure statements are free of material misstatements. They involve preparation, internal control review, and substantive testing. The audit report provides an opinion on financial presentation. Auditors can issue 4 types of opinions. An unqualified opinion means statements are fairly presented. A qualified opinion indicates a specific issue. An adverse opinion suggests significant errors. A disclaimer of opinion is due to audit limitations. Financial audits maintain trust and transparency. They are required for publicly traded companies. Audits may also be required by lenders and investors. They ensure financial statements are reliable. Audits are crucial for informed decision-making. Analyzing historical financial data identifies trends. It involves comparing past statements and ratios. This analysis reveals areas of strength and weakness. It supports strategic objectives and financial health assessment. Historical data comparison is key for informed decisions. In conclusion, the ability to interpret financial statements is essential for understanding an organization's financial performance and position. By analyzing key financial information, such as profitability, liquidity, and financial stability, stakeholders can make informed decisions. Interpreting financial statements supports performance evaluation, financial planning, and strategic decision-making. This skill enables businesses to identify strengths, weaknesses, and areas for improvement, contributing to effective financial management. Thank you for watching this video. If you have any questions, please feel free to contact us via email or WhatsApp at 0748 436 1688.